Let's continue this, but add another voice to the conversation. And your first guest tonight has a big old message. Don't make any big bets right now. Let's bring in Tony Dwyer, Canaccord's chief market strategist. You've been listening to us, Tony. Want to get your views on it. One of the other things that Paul Tudor Jones said on CNBC this morning is that he called the current environment, it's a family-friendly show, right, guy?
Can't say it.
Bat guano.
Nice.
Crazy. Right? $18,000 invisible statues, homes selling for hundreds of thousands of dollars above asking without being seen. I mean, where are we going and where are we investing right now?
But you can't get a snowmobile or a watercraft in any area around the Northeast because they're already sold out, and you're actually sold out into next year. There is just a shortage of and the supply constraint is really starting to come into play. But when we downgraded the market in mid-April, we saw a lot of risk from some of the most speculative areas. The SPACs were going nuts. You had commodities spiking higher. The whole market was ripping, especially the cyclicals. And a lot of those areas, that interest rates were up to 177 and nearly everybody was calling for 2%. That was a time where you have kind of a warning of the speculative excesses. Right now, I'm kind of in Karen's camp, where you do no harm. And by do no harm, I'm not giving this, oh my God, warning. This is just a be neutral. Don't make a big bet on your market exposure. And for those that most of our clients, they don't take market bets, they take sector bets. We're pretty neutral until we get a better indication of what the Fed's going to look like.
Okay, so let's say you got somebody listening right now, Tony, or watching, and they own the SPY or they own the QQQ, super broad-based index bets, risk averse. You're saying obviously don't add more to them, but do they sell them right now?
What we've been saying over the course of the last couple of months has been to take profit in those areas that saw speculative excess. So that would have been the financials. We did a relative downgrade of the banks in the financials in early March, because that's when rates peaked. I mean, you saw extraordinary things. People keep asking, what's the bond market telling us? What are the various indices telling us? What are the sectors telling us? And sometimes they move and they discount some of the action that is to come. And I think that was the case in early March. So yes, I think you hold what you have. We are still early in an economic and market cycle. Where I want to get, I'm kind of known as being bullish. Where I want to attack the market is when you have periods of weakness and periods of correction versus chasing, grinds higher like we're in now.
Yeah, and we're looking at a chart of the 10-year note. And here's what's interesting, despite all this talk, Tony, is that the 10-year bond yield has done nothing for 3 months. If anything, it has actually moved a little bit lower. I mean, there's been all these calls for 2% by the end of the year. Unless we see a major change in bond investors' attitudes, we could have a lower 10-year yield, to Dan's point, I think, than we do right now. If we do, or it stays where it is. Is that the all clear longer term? You're saying short term, but longer term, the all clear to stay in tech, to stay in high growth?
Well, you're definitely getting a bid there on the lower bond yields, just like you got a bid in the cyclicals on the higher bond yields. When we had initially talked about a peak in rates or a stall in rates, it came because the 10-week rate of change on the 10-year note yield, it's a technical indicator, got to a place that had only been twice before. And I think we highlighted this on the show. And anytime it's gotten to that point and peaked, which it did in early March, the first week of March, you've seen at best a trading range in yields and typically lower yields. It tells you that some of that strong economic expectation was already priced into the 10-year note yield. So we've even corrected that. Now commodities are in a correction. We're in the correction for the cyclicals. Where I've made a mistake is I expected this, all of a sudden you get a hit to everything. You take a risk-off hit. But the way that the market's made up now, it's been more of a rolling 5 to 10% correction, where every area is getting hit at its own time, based like the transports recently, based on its own individual outlook.
There's also, and I know Mel and the gang, they all like to talk about the FOMO trade, right? Fear of missing out. And there is also this train of thought among energy and some of the other unloved sectors, right? Either you can't own them or you don't want to own them. They're literally physically dirty, digging stuff out of the ground type trades. But guess what? Those have been the trades that have been making money. Do you think there's going to be this rush by fund managers, investors to show their clients that they own these things? Because the clients, they just want return. Do you think that, in other words, the upward momentum builds on the upward momentum as others say, oh, I better own that because I don't want my clients to know we haven't owned it?
So yeah, it's a tough one because now you've got transports down about 6.5% from peak. And you got the FANG stocks making new highs, or the NASDAQ composite on the back of the FANG stocks making new highs. So what do you want to show? You're seeing the commodities are down and the stocks related to the commodities, the transportations, as I said, the home builders, those economically sensitive areas that everybody was flooding into going into April and May are now pulling back pretty dramatically. So I'm not sure. See, here's the interesting thing. In the I would be happy to admit, forget it, correction's over. There's no more worry. You don't need to be defensive. But we're in a fundamental transition with an unclear Fed. And that's showing up in the markets because we made 2 new record highs in the S&P 500 over the last 3 days, and 2 of those days had more down volume than up volume. There's just a lot of indigestion, just like 2004, and just like Dan's 2010, where you've after the great financial crisis, you had an 81% ramp off the low, and then you went into this period of indigestion in the summer of 2010 as you try to figure out what that great market environment and economic outlook, what it was going to mean to assume maybe sooner than expected Fed transition away from, I guess it was QE1.
Well, we'll see if it is the pause that refreshes or the pause that disappoints, because we certainly do appear like we're in a slight pause right now. Tony Dwyer of Canaccord. Tony, a pleasure always to have you back on the program. Karen Fineman, wrap it up with a bow here. Do we think that there is some trade to be made off of FOMO or off of this idea that maybe that some of these things that we have not liked at all, they need to be bought? Or are you more in Tony's camp, which is, you know what, let's sit back, let's get through the summer, let's see where earnings estimates may, see what the Fed may do, and just kind of chill?
I'm trying to be chill. It's not really entirely my nature, but that's the way I'm positioned. Sitting back, not making any rash moves. I suppose with the VIX down here, probably add some protection, but not making any big moves in the portfolio. I don't think the Fed's doing anything right now.
Yeah, I suppose it would be more interesting, Tim, if somebody came on the show and said panic and make rash moves. Never heard anybody say that. Is there some sort of a trade that we need to be adjusting for right now as we look ahead to the Fed Wednesday or even a little bit further out?
Well, I think there's been a number of these phases where we've had these rolling column rotations, and you've seen that the NASDAQ, Tony said this, has outperformed the S&P by about 4% since in a month. And he pointed out that materials have sold off. We've all pointed out that a lot of commodity prices are down from their highs. But if you look at first quarter earnings revisions upward from Q1 earnings, energy's up about 25%, materials up about 19%, banks up about 17%. So those 3 sectors to me are the most interesting because of their earnings profile as much as anything. And they are inflation hedges, and they've sold off a bit. So I think those are your trades right now.
And if you think about Tony's call in April, I mean, although the S&P hasn't really cooperated, a lot of the underlying things have absolutely done what he thought. Look at the home builders, as Dan's talked about for the last couple of weeks. That's off probably 12% in the last 2 weeks or so. And you've seen those corrections. It just hasn't manifested itself for whatever reason in the broader market. My sense is it's going to rather soon.
Shepard Smith here. Thanks for watching CNBC on YouTube.